Hey, what's up YouTube? My name's Kepley. You're tuning in to howtoplaystock.com. Today is March 16, 2016, and in today's video, I wanted to cover the topic of the interest rate hike and the effects that's going to have on the stock market. I thought this was an appropriate video to shoot, considering Janet Yellen just raised the interest rate yesterday. The other thing I want to cover in regards to the interest rate hike is, not only the effects that it's going to have on the stock market, but the odds of a stock market crash, okay? Because believe it or not, right now, we're due for a market correction or a stock market crash, and it hasn't happened yet. So you're going to find out when I show you, what the odds are of corrections and stock market crashes actually happening in the stock market. You're going to find out that happens a lot more often than what you would imagine. And then the other thing I want to show you is the performance of the stock market over the past 200 years. All right, now I know I've got quite a few new subscribers who are watching my channel, and if they're investors, and they're planning on investing in the stock market, I want to kind of paint a better picture for them, and so they can understand where we are right now in the stock market, and they can make a better decision on, do they want to invest, do they want to hold on to cash, or do they want to get into safe haven assets. Okay, so this video is going to be about all three of those things, and it's going to give people a better picture and understanding of what they're dealing with when it comes to the stock market. So stick around, keep watching, and I'll see you guys in the next portion of this video. Alright, so we're back here, and today's topic, I want to cover the interest rate hike. So we'll start there, and I'm going to show you some of the effects that has on like stocks and equities. Okay. So yesterday, Janet Yellen raised the interest rate by 0.25 basis points. Guys, this is barely going to be noticeable in the markets. We've only had like 2 interest rate hikes in the last maybe year, and we saw what happened last time she raised the interest rates. That was at the beginning of 2016. We had the worst start in the history of stock market, ever. Okay, the GDP and the economy pretty much came to a grinding halt. So they're in a situation right now, the Fed is, where they really can't raise the interest rates too high. They're afraid to because it's going to pop this bubble. And that's what I was talking about with, a correction or a stock market crash that is, coming. Because you'll hear a lot of other people right now talking about it. I've been covering it myself. Everybody's talking about we need a stock market crash or a correction so we can get some of these stocks back down to fair value. Because right now there's no what's the word I'm looking for here? There's no really price mechanism in the markets, and therefore a lot of people really don't know what's a fair value for some of these assets. So they need to come down in price, and we're really due for a stock market crash. Now the interest rate hike, again, like I said, she only raised it 0.25 basis points. Okay, it stands at in between 0.75% and 1% now. So we'll see what happens moving forward, but I can tell you right now, she can't really do a whole lot more. Now she'll say, if you go in and you read the announcement or the speech that she made yesterday, she's saying and basically sounding pretty hawkish. And what I mean by that, she's saying that I have like 3 more interest rates that I want to implement, for the year 2017. Now we'll see if she does that, because Donald Trump's in office, okay, and this changed their whole game plan. They were planning on Hillary Clinton being in office. That didn't happen. So now the game plan's changed a little bit. I believe Janet Yellen might try to raise the interest rates a little bit more, but doing so might pop the bubble, and they don't want to be blamed for that. So you have to keep that in mind. The interest rate hike, basically what it's going to do for equities and stocks is the demand, and I'll include bonds, treasury bonds in this as well. The demand for short-term bonds, like the 2-year, 5-year, and 10-year, are going to increase. Okay, so if you're in safe haven assets like or low risk income investments like bonds or treasury bonds, you're going to be pretty pleased with that, I would imagine. The demand for it though is going to drive the prices down on treasury bonds. And in doing so, because there's more demand for them, the price will go down, the yield will increase. So for an investor, that's a great opportunity to get into bonds because the prices go down, which means you're kind of getting a discount on those, and then the yield goes up, so your returns are going to be more. All right, now, again, I think the Fed knows this, and for the last, I'd say almost decade, low-income investors who are looking at low-risk investments, or people who are, getting ready to retire, they've been getting murdered on bonds, on treasury bonds. The returns have been pretty much next to nothing. So they can't continue to do that to the people retiring, because we have more people retiring now. And the Fed knows that, so they don't want people getting fed up with that and getting mad at them. So they need, they knew they needed to do something, because what the Fed is looking for here is inflation, guys, which means they need prices to go up, okay? And when prices go up, your interest rates go up, and the companies out there can make more money. The other thing is the asset prices in equities will often decline. So get ready. Like I said, we're needing a correction. So the asset prices across the board on the stock market are probably going to start dropping here soon. Okay, and I'm talking probably in the next 3 to 4 months. The other thing is it reduces the present value of future cash flow. So, like, let's take REITs, for example. Those are real estate investment trusts. A lot of times, what you'll see is the prices on those go down as well, because it reduces the value of the cash flow in the future for companies like that. I had a conversation with a guy the other day about CDs, or certificate of deposits, and I said that the interest rate hike, when interest rates go up, certificate of deposits usually will yield a higher return. He hadn't noticed that yet, and I said, well, you're going to have to give it some time, because interest rates are, still fairly low. We're not even at 1%, so 0.25 basis points probably won't even affect a certificate of deposit or the yield on that, because it's just, a lot of it depends on the future cash flows of the company. So if the company's profitable, they don't have a whole lot of debt, they're going to be able to raise the yield on the return for certificate of deposit. Okay? You got to remember, a CD, when you buy a CD from a bank, basically what you're doing is you're lending your money to them, and they're giving you a promise that they'll pay you back in the future. So they got to make sure that money's there, and that has to do with your present value of future cash flows. So they have to make sure that they have future cash flow there, so they can pay you back, if that makes sense. So that's basically the interest rate hike and the effects that that's going to have on equities. Now, the next thing I want to show you here, I just want to point out a couple things before I show you the performance over the past 200 years on the stock market. And that is, we have a correction, guys. Believe it or not, every year, okay? The stock market goes through a correction almost every single year. Now, it may not be a whole lot, but those corrections are pullbacks where the price or the value of assets in the stock market goes down. The other thing is, every 3 to 4 years, the stock market as a whole, every 3 to 4 years, it will suffer through a correction, which means that the prices or the asset value of the entire stock market usually will drop somewhere in between like 5 and 10%. Okay, now those are pretty often occurrences when it comes to pullbacks on the stock market and asset values going down. What I'm going to show you now is the performance over the past 200 years on the stock market, and I'm going to show you how often crashes happen, and kind of what your odds are for being an investor who's looking, if you're looking at investing right now, I'm going to show you, kind of where we are or what you can expect moving forward in the future, okay? So stick around, keep watching, and I'll show you some of the results over the past 200 years on the broad stock market. This isn't just one individual company. This is for the entire stock market as a whole.
Okay, so now we're going to be looking at the performance of the stock market over the past 200 years. This is going from 1825 to 2013. So some of these, it's not, there's about 4 years missing in here because we're in 2017 now. So it is fairly accurate though. The website that I'm looking at here is Base Hit Investing. The man who wrote this, the author, his name's John Huber. He's with Saber Capital Management, and he manages clients' accounts for them when it comes to systemic risk on investments. So he does have some credentials behind his name, and what he found here I thought was really interesting because it shows you the performance of the stock market over the past 200 years. And like I said before, if you're a new investor or somebody who's new to my channel and you're planning on making some investments into the stock market and you want to play stocks, you need to know kind of the game that you're playing here and what to expect moving forward, okay, with the stock market. So let's get started here. The market had 134 positive years and 55 negative years. That's in the past 200 years. The market was up 71% of the time. Okay, 44% of the time the market finished the year between 0 and a return of 20%. 60% of the time the market finished the year between negative 10% and plus 20%. And check this out. In the last 200 years, only 14% of the time, that's 26 out of 189 years. So correct me there. It's not 200 years, it's 189 years. Only 14% of the time did the market finish worse than negative 10%. So 26 out of 189 years, the market finished worse than negative 10%. Only a mere 4.8% of the time, fewer than 1 in 20 years, did the market finish worse than negative 20%. So these are the odds I was talking about when it comes to investing in the stock market and what your returns are going to be. Not to mention, earlier I said every 3 to 4 years the market will have a correction, and it'll correct within about 5 to 10%. Well, here's the other thing. Every 3 to 4 years, the markets will actually finish down or negative as well. Okay? So those are some things that you need to look at when it comes to investing in equities and stocks, because I guess some people that ask me, hey, what stocks are you investing in as far as like your indexing strategy? And the one thing I want to tell them, if they're listening to this right now, is that you don't want to get into equities and stocks if they're overvalued. It doesn't make sense. Why would you want to lose money? The name of the game here is not to lose money. That's rule number 1. Rule number 2, according to Warren Buffett, is don't lose your money. So just follow rule number 1. And with that being said, right now is not a good time to invest. I keep telling people we're getting ready to go into a stock market crash. You've got the interest rate hike that just took place yesterday. Now we're talking about the debt ceiling, and if they don't lift the debt ceiling so that they can print more money, you're looking at probably a government default or a government shutdown, okay, which isn't going to be good for the markets either, because the markets will realize the government's out of cash All right, and then what happens? The market comes down because it realizes, oh crap, we're in an economic recession. All right, so you've got both of those things at play. The other thing is, if inflation kicks in, like I was saying earlier, they want inflation. Okay, if that kicks back in, which it will, because you got to remember the money that they've been printing up through quantitative easing sat in their reserves on the Federal Reserve. Now those reserves, which is roughly $2 or $3 trillion at least in quantitative easing to keep the markets propped up over the last decade, that money's going to start going back in to the stock market and into the economy. It's got to start flooding back in. When you get that, you get inflation, okay, which means the prices are going to start going up and your interest rates are going to start going up. Well, right now our economy is weak. It doesn't make sense. You do not want that to happen with a weak economy because it's going to implode. So just some things to keep in mind for people who are watching this, who are new to the channel, as well as people who have been subscribers of mine ever since I started last year. These are things that you guys want to look at and consider before you put your money into the stock market. Because my strategy right now, I'm staying away from equities, really. I mean, I'm doing some growth investing through my real estate investment trust, but it's money I can afford to lose, okay? And I'm just working on building my passive income with that, and I've got safe haven assets set up so that when this thing starts coming down, I'm going to profit. I'm going to have some serious, good profits coming in off the stock market crash, and then I can, I can use a strategy like John Templeton uses. If you don't know who John Templeton is, just subscribe to my channel. You can go in and watch a couple videos, and you'll know his strategy that he used. Okay, so I just wanted to inform everybody about what's going on here, show you the history or the performance of the stock market over the past 200 years here, and also let you know, what effects the interest rate hike is going to have on equities moving forward. So I hope I was able to give you a clear picture here and help you sleep better at night, even if you are invested in equities right now. If you're younger, guys, don't be afraid. Okay, don't be afraid of this. Embrace it, because you're going to get discounted prices here really soon on a lot of the different assets. You're going to be able to buy them up for good discounts and then just ride that wave back up. Now, if you're older and you don't have a whole lot of time on your hands right now, you might want to seriously consider taking some money off the table with some of these equities, because they're coming down and you really can't, if you're older, that means you have less time before you retire. You're going to have less time to basically get that money back. Okay, so you might want to take some of that cash off the table, start looking at maybe some annuities or something like that. That's all I have for today's video. I hope you guys found this beneficial. Go ahead and share and like it with others. Subscribe to the channel if you're not subscribed yet. And these are today's investors' investing tips. Just remember, be patient, and income is the outcome. I'll talk to you guys later.